Welcome again to Back and Forth. This is Blue Ridge Wealth Planners. My name is John Vandergriff. I'm one of the owners and wealth planners of Blue Ridge Wealth Planners. I'm joined, as always, by Zach Hill, our operations team lead / portfolio guru / remedy coffee man. You're going to get a lot of
I like
here.
the added titles each week.
Yeah. It's just names that say what you do. That's what a title is. So what we're doing today is talking about a topic that you may think we are not unbiased to give, but I think it's a good topic to go back and forth on, and that is whether a financial advisor is needed, important, whether you should use one, however you want to verbalize that, but kind of pros and cons of having a financial advisor. And obviously, with our company being based on financial planning, with me being a financial advisor, I will probably take the pro financial advisor approach so that I don't have to force myself to quit. Zach is going to take the approach which, is more reflective of his background and different things of maybe why an advisor may not be a fit for a time potentially, or, kind of we may even go into kind of what things you may need an advisor for at different stages, because that may be a good thing to kind of give some people a little bit of guidance. Because I think, the main deal that we have to look at is just getting the appropriate amount of advice for whatever the period of time that you're in.
Right.
And I even had this conversation the other day with a younger person that was saving, and I was like, honestly, the complexity of a financial plan increases as the assets grow,
right.
But that's not the only thing, because sometimes you may need a little bit of guidance at the beginning of that process. So again, we're going to go back and forth on this, just see how this conversation evolves. And so I will kind of tee Zach up to go ahead and take why a financial advisor may not be a good fit for you. Maybe is the best way to say that. So.
Yeah, and I think you've already kind of set me up for the first thing that I want to cover, which is it's really dependent on how many assets you have.
Mm-hmm.
Is if you don't have many assets, a financial advisor might not be able to do much more for you than you're able to do for yourself. There's a couple of different examples for that. One is obviously someone who potentially is a recent college graduate or just entered the workforce and really hasn't had any time to accumulate wealth. Is you've been in college for the last 4 years, this is your first job, and you've got $5,000 saved up. Definitely don't need a financial advisor. You're going to waste their time. You're going to waste your time. Any good financial advisor will just tell you, keep saving. And I think that's really important because that stage of life could be for a prolonged period of time. There are a lot of advisors who won't take any clients unless they have a certain number of assets, at like a certain dollar amount, whether that's six figures or up. And so there's a lot of people who don't have that. And so for those people, a financial advisor, I don't think is really an appropriate fit. And so that tends to skew on the younger end just because, like I said, you just haven't had time to accumulate wealth. And so what that does is it also that means that most people who are on the younger end are higher on the risk tolerance as well, which means that for a lot of young people with no assets, put it in an index fund. Go to Vanguard, go to Fidelity, open up just about any brokerage account you can, any IRA, Roth IRA, just put it in an index fund and let it sit there and keep adding to it. Mm-hmm. And so I think that for most people who are younger and don't have as many assets as older people, I don't really know if there's a better fiduciary decision for that person for a long period of time. That could be 10, 15, 20 years that you do have that period of time, just because if you've got $10,000 and the most you can lose is $10,000, and that's probably not much relative to where your assets would be in 30, 40, 50 years. You don't have much to lose. There's a high risk tolerance there. And so I think those people going to an advisor and paying an advisory fee, even if you find an advisor that'll take you on as a client, it's just any good fiduciary, in my opinion, would say you don't need this. You need to handle your own money.
Yeah, and I guess talk about why this stigma has happened, where people feel like they almost can't start without a financial advisor, because I mean, it's kind of going back to the way things almost used to be.
Yeah, exactly. Because it used to be a much, much harder to open up an account at Vanguard any kind of IRA or any investments were really difficult up until around the early 2000s when ETFs came into play, because ETFs allowed you to buy an index fund for a fractional price. So in the past, you would have mutual funds that were only sold through advisors who required a $50,000 account minimum. And then those mutual funds had a 2% expense ratio or 3% expense ratio on top of all of that. And so you really didn't have a way to just go and say, I want to buy the stock market. That was a very blanket term, and we've said, oh, just put it all in stock. So what does that actually mean? And so really until the last 20 years, there wasn't an efficient way to do that. And that's thanks to ETFs and also just thanks to the internet. That sounds kind of cliche to say, but now anybody can go online and enter in their personal information at Vanguard and open up an account in 5 to 10 minutes. Yeah. And that just wasn't possible 20 years ago. And now at the same time, you can do that and with as little as $1,000 start investing.
Yep.
And those barriers to entry were so much higher in the 70s and 80s when you had financial advisors starting to get licensed, and they would say, we've got a great mutual fund for you, and then nobody even knew what index funds weren't around, so you couldn't say, well, is it an index fund? Is expense ratio low? Those questions just didn't fundamentally exist.
Yeah, and so I think, that transparency has helped investors definitely, and, I tell people this all the time that, this is the best time in the history of investing for an individual to be able to invest money on their own when it comes to trying to build that wealth over time. And I think, like you hit on with mutual funds, like that was a way that if you didn't have enough money to buy a full share of whatever company's stock, you could mutually own that with other people. And so now, with the way that with the way that markets are today, you can just decide whatever dollar amount you want to put in and buy whatever percentage or fractional shares or different things. I think even recently was you could buy fractional shares.
Yeah, you can buy fractional shares because everybody wants to, we talk about this a lot. It's a great example. You say, I want to buy Amazon. I don't want to buy an index fund. I want to buy Amazon. Well, you got to have $2,500 to buy one share of Amazon.
Right.
If you're 22 years old, $2,500 is a lot of money.
Well, especially if you're trying to save monthly.
Yeah, exactly.
So, one share a month is a pretty good price.
Now you can find somewhere that's going to let you buy a fourth of a share. It was hard enough to buy one share if you had money in 1980 and you had to go through a financial advisor, place an order, maybe call it in, do all that. Now you can do it on an app on your phone in less than 5 minutes. It's just,
right. And I think the fee compression of the industry has also helped the individuals to not have to get gouged in some ways, maybe from a financial advisor standpoint. Because, as you look at things, financial advisors can almost get paid if it's not a management fee platform. They can get paid coming and going, of the churning of the positions. And sometimes in the past, that's been a situation where an advisor has been able to talk people into trading stock positions, if nothing else, so that they could create commissions.
Yeah, and so the transparency that's happened in the last 20 years has been really good for that. ETFs versus mutual funds, even the transparency there, where you get to see what is actually in the ETF on a regular basis, sometimes a daily basis, where mutual funds, you don't get to see that, but mostly on a quarterly basis. The transparency even within the products you're investing in, or like you said, with the advisors themselves and the transparency that they now offer due to the market changes is much better.
Yeah, and I'd say just so we can kind of segment this conversation between like financial advice for younger people and then financial advice for older people, because I think that, and again, who's older people? It really is in the eye of the beholder. But, when you look at starting out, if you were making an argument for a financial advisor helping a young couple, it's trying to project out into the future, because like we've talked about, with the problems associated with Social Security, most people our age probably aren't factoring that into the equation or shouldn't be for a significant portion. So then it puts more and more pressure on those investments. And if we combine the lack of income sources with inflationary increase over time, like that gets to be just a super big number that's really hard for us to project, wow, I could need this much money at some stage of the game. So I think some conversations, and typically like in our business, this comes from, when we get a client that's at retirement age, they want us to talk to their kids about, planning and different things, which, you can make an argument. Planning advice at the beginning is important just to know, kind of how much to save and doing different
Right.
things like that. And then obviously as that transitions to a different stage, the importance goes up, like we'll talk about in a second. But I think trying to project out and, again, just to use some rules of thumb, but not to totally harp on them, trying to project out and say, what is a number that we can take 4% of and be able to make life work? And obviously there's a lot to do with how you would invest that money to get that 4%.
Right.
But I think that allows people to kind of go out 20 years and say, okay, I need to be shooting at this number for a potential goal so that I can take 4% of that and support my lifestyle.
Right.
Yeah,
and I think if you're, and I want to argue against having a financial advisor. And so the argument there would be I think if you're in that young stage and you're projecting out these really long numbers, like you said, maybe you can make an argument that you meet with them once at the beginning to get all the basics, and then maybe on a periodic basis as far as every couple of years or something. But that's at most. And if you're that young and you're projecting out big numbers, you're just trying to make sure, okay, do you have automatic savings plans in place? Are you saving a right percentage of your income on a regular basis? Oh, your IRA balance is growing by this amount. That's good. You're on track. Just keep it going. And those meetings can be so fast that I think you can accomplish those purposes in a lot of different ways now. I mean, that's where there in the last few years you've seen people say, well, our robo-advisor is going to replace financial advisors. I think you could make that argument for younger people is that, yes, because they'll ask you the same 4 or 5 questions every year for the next 15 years. Mm-hmm. And they're not going to have any thought in it, but you need to be doing the same thing for a very long time. And so it'll be able to tell you whether you get on those numbers. But I think that would be the best argument, for those platforms, for the robo-advisor platforms, and against the advisor would be if you are just in that position, like you said, you're just building to this really large number to get to that 4%.
Yeah, and like we said, I mean, I think you put it well, we're maybe having that conversation at the beginning, just getting the savings machine going is really the essential thing, because I think sometimes people think they can be saving enough and then they severely undershoot the mark of where they need to be. Yeah. And they were disciplined in their saving. They just didn't realize how big of a number they needed to put away early.
Right. Or have a dollar cost averaging program. I have talked to some of my friends before as I've helped them try to get that conversation started. And I've said one of the best things you can do is set up a automatic investment program to come out of your bank account every month or even every paycheck, and just have it similar to a 401k, and then just forget about it.
Yeah.
Just set it to a high percentage that you can withstand, and then if you get a raise, maybe go in there and increase it a little bit. But for the most part, just set it and forget it. But having that initial conversation to let everybody know that those things are out there, I think could be important. But after that, it's just set it and go.
Right. And so as we look at it, we want to make sure people are able to get, and again, there's so much information out there, trying to weed through that and get what you need is really essential in a lot of ways. So, we want to make ourselves available for that. Our website, Blue Ridge Wealth. You can get resources on investing, maybe even set up times. But again, we'll kind of transition now to kind of as you age, the importance of a financial advisor, and maybe, just kind of comparing that versus not having one even in those younger years in just a second when we come back on Back and Forth.
Are you nearing the age of retirement? Is your 401k not looking the way you'd hoped all those years ago? Retirement is supposed to be a time to relax, a time to live. Here at Blue Ridge Wealth Planners, we strive to provide that service and opportunity. We can help you form a plan that will maintain and grow your retirement savings so that you can achieve what you envisioned when you originally set out on this journey. To see where you sit and what you can do to stand again, visit planforeverything.com. That's planforeverything.com. Blue Ridge Wealth Planners. Let us plan for everything so you don't have to.
All right, welcome back to Back and Forth. This is John Vandergriff, Zach Hill, going back and forth about the importance of financial advisors, whether or not we need them, and maybe at what stages they become more valuable to a financial situation than before. And so we talked about in that younger phase of life, and we'll talk about this, maybe not even just like the lower asset level, because we'll talk about how maybe that can be a very important arena to plan in. But being at that lower asset, lower age range, the more risk that you take, you don't really need an advisor to position those things because there's a lot of resources out there. It's just the consistency of saving and the consistency of leaving that money in risky positions, even if it loses money.
Right.
So as we look at it, as we talk about the importance of an advisor, we want to be in a position where we understand that as the needs of our money grow, the complexity of our situation changes. So, as we're working through our lives and we're aging, we're telling our money grow as fast as possible, and we're trying to add gasoline to that by the contributions that we make. And so when we get to a period of our life, maybe at retirement, maybe early retirement, but once you start to have substantial assets, that you now are shifting the focus from just growing money to doing other things with it than just growing and taking an above average level of risk. That's where you want to start involving a financial advisor to help kind of break up that portfolio and give kind of defined jobs to different pockets of money. Right. I was having a conversation with a guy just before this, and like we've talked about, now is a great time for you to invest your money. But as you look at what individual investors can do on their own versus what they can't, I would say more of the aggressive, passive platform is really the advantage of an individual investor that you see, like the Vanguards, like we've talked about, where people can do things on their own, keep their fees super efficient, but at the same time, you really can't keep those buckets from losing money very well. You know, I mean, it's just they're going to do whatever the index does. And so if you get lucky and you pick an index that doesn't lose in turbulent times, it's more luck of the draw than like actually planned risk management. And so so where a financial advisor should be able to add a lot of value in that conversation is exposing you to instruments that you just can't get on your own, whether it's because you don't have enough education, you don't have enough licensing, or there are specific relationships required for those that you just don't get if you're, a person walking in off the street trying to go to a brokerage system. Yeah,
and the diversification that provides is so different from the diversification you would get at a Vanguard or something like that. You already said that, as most people think about a 60% stock, 40% bond portfolio, but when you talk to a financial advisor, they can open up that diversification to a world of different things.
Yeah, because it's not just stocks and bonds and thousands of stocks and thousands of bonds, but it's like, how can we actually get things that act totally different? And so as we look at it, where most people transition into retirement is they're trying to shift from this growth focus primarily to how do I preserve this gain that I've had over a long period of time, and then how do I turn this bucket into a thing that provides income for me when I stop working? And those jobs are drastically different than we just want to grow your money and hope it takes care of everything, which is unfortunately the way that most of the financial industry manages money. Yeah. It's just we're going to grow this money at a reckless abandon and hope it takes care of everything else that you need.
Yeah, there's no individual planning at all. It's just all about growth. It's let's look at the percentage, the annual return on this, the annualized return, and that's what you should plan on getting and grow it. Right. That's it. There's no like, oh, what's your actual situation? Let me talk to you and figure out what's actually appropriate for you.
And as you look at it, there will be some people that will probably argue, oh, well, advisors are going to be watching different stocks more than I will. So they're going to be maybe a part that I need to do in this growth phase of my life. You could say that, but you've got to make sure that you examine the fee structure of that relationship pretty carefully. Right. And the thing that you run into, like we've talked about on the show before with individual stocks, is they make a bad pick. You're taking a lot more risk in that one position instead of spreading the risk out. So as we look at it, sometimes we even have relationships with clients where if they've been managing their own money for 10 or 20 years, they may continue to manage the risky piece of it and then let us come in and provide some of the more conservative risk management type of positions, like conservatively managed positions, or maybe diversification into real estate, maybe some insurance products, things that are going to have obviously different opportunities but different risk thresholds than just traditional stock investing, so that it allows the investor to know, okay, I can be as aggressive as maybe I want to be with this portion of my money because I have this other money over here that's really helping me balance the risk scale.
Right. Yeah, and we've talked about even if you do, use an advisor for the riskiest portion of your assets, there are small changes in that advisors should be looking at and are taking advantage of. Like we've said before, there was a big 20, 30-year period where value investing outperformed growth, and then lately it's been growth. So the advisor should be watching that and knowing kind of, maybe it's time to start tilting you back towards value, and so you can provide some value there as an advisor, just even on the riskiest portion of the assets that other places may not.
Yeah, it's just, I think the thing that drives me a little crazy, from a kind of fiduciary aspect, is I've seen many a situation where somebody comes in with a brokerage statement and they have a managed stock position where the positions have not been touched in 4 years.
Yeah.
And they've paid over a percentage fee every year just for that person to squat on this money, for lack of a better term.
Yeah.
That's not management. You can do that. You don't need a financial advisor to charge you 1% to own Apple stock. So that that platform makes it to where an advisor relationship, if there's not management going on, you may look at that and say, I want to move this in kind to somewhere else and lower my cost at worst case. But then adding an advisor in for the process of, obviously diversification of assets, but also the planning conversation. Mm-hmm. And that's where you want to be careful, because sometimes people think, oh, well, I don't need an advisor because I don't have enough money. And they think, I've got to have $10 million to be able to benefit from a financial planner. And the reality is, like our company is Blue Ridge Wealth Planners. Wealth in our country is defined so differently because of just the divide, unfortunately. And I think, education and resources is a big thing that we want to help provide people with. But, this is a statistic that's a few years old. But at the time, people that were retirement age that had saved $250,000 or more in our country was 1 out of 7. Yeah. So, wealth is not $10 million. It may be $250,000. Right. And I would argue at that level, you can do a lot of damage really quickly if you don't know what you're doing. And so again, you can say, somebody has $500 to invest. That is a situation where it's not going to matter too much where you put that. But if you've got $500,000, like, you can do some things over the next 10 years to really screw that up if you don't have the right advice or situation to plan for kind of some of those things and really knowing how much you can pull off of it. I don't think I've shared this on here, but have had situations where people had over $1 million portfolio, no advisor advised them on how much money they should be taking off of it, and so they were fully invested in stocks, taking over 10% of their money, which again is irresponsible, no matter how good the market is. Taking 10% out, and then an event like 2008 happens, and 8 years later they have $200,000 out of $1 million start value. It's like, tell me they're not going to run out of money if they don't get some advice in that situation. So,
or a lot of people have a significant portion of their wealth in their 401ks that they haven't looked at. Yeah, they're nearing retirement, and then, like you said, what just happened in the first quarter of 2020 happens, and they look at it, and 30% of their wealth is down, and they were planning on retiring in 6 months, and they just haven't even thought about it or talked to anybody about those things.
Yeah, and I think, as you look at that, that's an interesting dynamic because, again, you may consider that you have a financial advisor through your 401k, but really there's not a huge level of planning going on there from how do I take this bucket and turn it into an income in my retirement years. And so being in a place where having a conversation with somebody that is experienced in that level of planning is really like you would do in any area. If you're trying to plan a vacation to Disney World and you go talk to somebody who's never done it, they may be able to help you. They may Google just as well as you can Google. But you want to find one of these Disney travel agents, man, they know what they're talking about. It's like you got to find the expert for whatever the phase of life is. And so, for us, our job is not to manage risky assets and double values in 5 years. It's to help people income plan and preserve their assets. So it's, like that's our niche in the marketplace. And for people that's a fit for, we're a great fit. For people that are wanting to double their money, we'll probably tell them to go somewhere else. But I think that's the thing, too, where there are some different specialties even inside of the financial advisor range, where as long as you get somebody that's a fiduciary and as long as you get somebody that's experienced in the level of planning that you need, I think you're going to be okay, and it'll be worth your time and maybe even paying that person to take on his advisor relationship. It's just making sure that you kind of clear and check those boxes first.
Right.
I think is really the big thing. So again, hopefully this was very valuable for you as you listen to us go back and forth. Obviously, we're a little biased. We see the value, but again, we'll acknowledge that there are certain periods of time in life where you need to just do some things on your own as long as you can be disciplined. We didn't even talk about this, but sometimes the job of a financial advisor can be an emotional coach to talk you out of making bad decisions with your money. But again, as you're staying disciplined as you get younger, really the value and the need for that starts to go up as your age increases, as your wealth increases, and you're in a position where you need some guidance on, again, how to divide these buckets into different things and conquer. So again, hopefully that was valuable to you. If you have any questions, info@blueridgewealth.com would be a great place to send some questions. We may even do a podcast sometime where we answer financial questions, but right now we're just taking topics and going back and forth. So hopefully you enjoyed our episode today. We look forward to sharing it again with you later, but that's all.
Investment advisory services offered through Blue Ridge Wealth Planners, a registered investment advisor. Securities offered through Madison Avenue Securities, LLC, member FINRA, SIPC, MAS, and Blue Ridge Wealth Planners are not affiliated companies.